Hello, this is Gail Kavanaugh, and I am with the Gail Kavanaugh's Financial Services. I'm a licensed life insurance agent in the state of Rhode Island. And today I want to talk to you about trust funds and accumulating wealth with life insurance. Did you know that you can accumulate wealth with life insurance? Well, I'm here to tell you that this is how the wealthy people do it. See, life insurance, there's several reasons why purchasing a whole life insurance policy can assist in accumulating wealth for the family. And this is not a concept that is really known by some families. It's a concept that many wealthy families use to accumulate wealth. A whole life insurance policy is one that accumulates cash value while providing a fixed benefit amount to a beneficiary upon the death of the policyholder. And this death benefit is guaranteed and will always be there if the premiums are paid. Now, the cash value begins to accumulate within 2 to 3 years, depending on the life insurance company which is providing the benefit. The cash value accumulates in the policy every year and is not a value which can be lost due to a declining stock market. Therefore, the value never declines. This is beneficial if the policy owner needs to withdraw the cash for an impending need. On the contrary, money that is invested in stocks and mutual funds fluctuate every year, and there is no guarantee against loss. Now, additionally, the policyholder can have access to the cash value in the whole life insurance policy without having to pay taxes or a penalty. Now, he or she would only have to pay the money back with interest, usually about 6%, if they desire to pay it back. If they do not pay it back, the amount borrowed is deducted from the death benefit. Now, to increase wealth, the policyholders can use the cash value for real estate purchases, for automobile financing, and private lending. Now, most people will use it for the emergencies which transpire, such as flat tires or replacement of appliances. Now, however, consider using the cash value to accelerate your wealth with real estate or for a down payment on an automobile. And this will involve planning to determine the best time to make a purchase such as this. But purchasing a home will result in a tax shelter for many families and individuals. So that's tax-free money that can get you a tax shelter. So if the policyholder is building an estate and has a will, the family can live on the life insurance proceeds while the estate is being settled. In some states, it may take 18 months before the estate can be settled in probate court, which means that none of the assets can be touched until that time. So this would allow the family to continue their normal lifestyle while waiting for a court date. And any other money is tied up in the estate and cannot be touched until the estate is settled. Now, the whole life insurance policy can also be used to transfer wealth. If a family desires to leave a son or daughter a lump sum of cash to help them build their own estate, they can purchase a life insurance policy for pennies on the dollar and name the son or daughter as a beneficiary. If concerned that the son or daughter may squander the money, the parent can place the life insurance in a trust and designate how the money will be paid out. Now, it can be paid out in monthly installments rather than as one lump sum. So parents do not have to have an exorbitant amount of money to place in a trust. Seeking the advice of a trust attorney is highly recommended if this is what you'd like to do. So one way of avoiding financial calamity upon the death of a breadwinner is to purchase the life insurance on the person to replace the lost income upon his death. If a spouse relies heavily on that income, it could be sorely missed when the breadwinner passes away, especially prematurely. This should be a consideration when meeting with a life insurance agent. 1 Timothy 5:8 says, "But if anyone does not provide for his own, and especially for those of his own household, he has denied the faith and is worse than an unbeliever." Now, one of the ways in which a policyholder can control the discernment of the life insurance, disbursement of the life insurance proceeds paid to their beneficiaries is with a trust fund. So the wealthy classes have used the insurance as a form of wealth transfer for many years. And instead of using their own cash to transfer wealth to their children or their relatives, they will often purchase large amounts of life insurance and name their family members as beneficiaries. To avoid squandering of the life insurance proceeds, the policy owners would place the life insurance in a trust, designating when and how the money is to be dispersed. In this way, the parent can limit the amount of life insurance coming out of the trust at one time to monthly payments over the life of the individual to help him or her be more responsible with the proceeds. Now, if the family desires wealth for their children, they must consider how the money is going to be spent. The parents should not extend the wealth to their children unless they have been properly trained and counseled in how to manage money and they have the plan to use the money. This should be a training that begins in childhood and extends through their early adult years. They should have a good education and should know how to manage money responsibly in their early adult years. The Bible says in Proverbs 22:6, "Train up a child in the way he should go, and when he is old, he will not depart from it." This is especially recommended for people who grew up in poor families and have become affluent in their own lifetimes. We have heard of countless stories, for instance, of people who have won the lottery and have become destitute after a time of squandering the money instead of making plans to spend it. Today, people do not need $1 million to have a trust fund. It can be a large enough sum that you feel would be too large of a sum of money for your child to manage without squandering it. The most attractive feature of purchasing life insurance to transfer wealth to the family is that life insurance can be purchased for pennies on the dollar. For example, if you purchase a $50,000 whole life insurance policy for $80 per month at age 45 and paid it for 30 years until your death, you would have spent $28,800 and your beneficiaries would receive the $50,000. And you've only spent $28,800 on it. Now that's a deal. While you are paying into that life insurance policy, you can have access to the cash value in the policy for emergencies during your lifetime, but you could capitalize on the policy if you choose to use it for increasing your wealth, such as a down payment on a home, a car, or to invest it into a business. So, in conclusion, a final expense policy is not the only way to use life insurance. The tax-free money that accumulates in a life insurance policy can be used to accelerate wealth, and it's not subject to loss due to market fluctuations, and it's not taxed. So families should ensure that they do have a whole life insurance policy for flexibility and tax savings during times of need, in addition to a policy for final expense. So I hope this has helped you, and I hope you do more planning as a result of listening to this lecture. And if you have any further questions about this, do not hesitate to call your life insurance agent or contact me here on Facebook, and I would be very happy to help you with this. So take care, and keep looking at my Facebook fan page for updates.